Stop scrolling. Pause whatever you're doing. Something major just happened in the precious metals market, and almost nobody understands what it really means. Gold didn't just dip, it broke down. Silver didn't just retrace, it collapsed in a matter of hours. This isn't a normal pullback. This isn't routine volatility. This is the kind of move that forces liquidations, triggers margin calls, and exposes leverage hiding beneath the surface. And here's the truth. When moves like this begin, they rarely end quietly. By the end of this breakdown, you will see the pattern most investors completely miss. Gold smashed through a key psychological level and didn't stabilize. Silver fell with extreme speed. Not over weeks, not over days, but within hours. That kind of velocity signals stress, real stress. In healthy markets, assets correct in waves. Buyers step in near support. Sellers take profit. Price finds balance. What we're witnessing now is not balance. It's imbalance. When a critical support zone fails and price doesn't bounce, it means the bids underneath have vanished. That tells you something bigger is happening behind the scenes. The issue isn't fear alone. It isn't retail panic. It's liquidity. Markets today run on leverage. Hedge funds, institutions, commodity desks, they don't just buy metals outright. They borrow against positions. They amplify exposure. That works beautifully when prices rise. It becomes catastrophic when prices fall quickly. When gold drops sharply, leveraged silver positions get hit harder. When silver drops hard, margin calls begin. And margin calls do not ask whether you believe in the long-term thesis. They do not care about geopolitical tension. They do not wait for fundamentals to recover. They demand cash immediately. If cash isn't available, positions get liquidated automatically. That liquidation pushes prices lower. Lower prices trigger more margin calls. More margin calls create more forced selling. That selling drives prices even further down. It becomes a cascade. The frightening part is this. During forced liquidation events, safe haven assets fall alongside risk assets. Everything gets sold, not because everything is worthless, but because cash becomes the only priority. So when gold falls during global instability, when silver drops while supply deficits still exist, when bonds and crypto slide simultaneously, you're not looking at a change in fundamentals. You're looking at a liquidity squeeze. And liquidity squeezes do not end when investors feel better. They end only when leverage has been flushed out of the system. That process can be violent. Here's where it gets even more interesting and far more important. This type of crash is not new. It has happened before, multiple times. And every time, the public misread it the same way. They saw gold falling and assumed the safe haven narrative was dead. They saw silver collapsing and assumed the bull case was broken. They assumed price equals truth. But price in the short term reflects positioning, not reality. There's a massive difference between voluntary selling and forced liquidation. Voluntary sellers stop when they think value has been reached. Forced sellers stop only when they run out of assets to sell. That distinction changes everything. Behind today's volatility, there are warning signals flashing in the broader financial plumbing. Emergency funding facilities being tapped, overnight liquidity being requested, short-term funding stress appearing where calm existed just days ago. Banks don't access emergency liquidity windows because they feel bored. They access them when they need immediate cash. And when institutions need immediate cash, they don't negotiate with charts. They sell what they can sell, instantly. That includes gold. That includes silver. That includes assets they fundamentally believe in. Now, here is the part most commentators won to tell you every major precious metals crash triggered by forced liquidation has followed the same structure. Initial spike, heavy leverage buildup, sudden catalyst, violent liquidation, public panic, media declares the trade dead, and then, months later, prices exceed their previous highs, every single time. But timing is unpredictable. The flush phase can last longer than anyone expects. It can overshoot logical valuation. It can break emotional conviction. That's what makes it dangerous. So the real question isn't whether volatility exists. It is whether this event fits the historical forced liquidation template, or whether something fundamentally different is happening. To answer that, we need to walk through history carefully. To understand what is happening right now, you have to zoom out. Not days, not weeks, years. Because what feels shocking in the moment often follows a pattern that has already played out before. Let a yes start with a hard truth. Precious metals do not move in straight lines during crises. They never have. Go back to the 2008 financial collapse. The global banking system was unraveling. Major institutions were failing. Credit markets were freezing. Fear was everywhere. If there was ever a moment when gold should have gone straight up without interruption, that was it. Instead, gold fell sharply. Silver collapsed even harder. Why? Did systemic risk disappear? No, it exploded. But leveraged funds were drowning. Hedge funds weren't just long gold. They were long equities, real estate derivatives, structured credit products. When those positions imploded, they needed immediate liquidity. To get it, they sold whatever they could, including gold. They didn't sell because they stopped believing in gold. They sold because they needed dollars. That distinction matters. The selling was not ideological, it was mechanical. Once that forced liquidation phase ended, something extraordinary happened. Gold didn't just recover to previous levels, it surged for years. Silver didn't just bounce, soon it multiplied several times over. The crash phase lasted months, the recovery phase lasted years. Now fast forward to 2011, silver had been on an aggressive run, speculation was high, retail participation was surging, leverage was building quietly in the background. When prices accelerate too quickly, margin debt accelerates with them. It's human nature. Confidence breeds risk-taking. Then exchanges raised margin requirements, not once, multiple times. That was the trigger. Positions that were safe under old requirements suddenly became over-leveraged. Traders had to post more capital immediately or face liquidation. Many couldn't. Silver dropped nearly 50% in weeks. The headlines declared the bubble dead. Analysts mocked the silver mania. Retail investors who bought near the highs were shaken out. But again, the underlying industrial uses for silver didn't vanish. Monetary concerns didn't disappear. What vanished was excess leverage. Now jump to March 2020. A global shutdown begins. Markets panic, equities crash. Corporate bonds wobble. Oil collapses. Crypto plunges. Gold falls too. That confuses people every time. Why would gold drop during chaos? Because in a liquidity crunch, correlations go to 1. When everyone needs cash at the same time, everything liquid gets sold. Funds don't sit around debating long-term thesis during margin calls. They hit the sell button. In March 2020, gold dropped sharply in days. But by August of that same year, it was making new all-time highs. Again, crash phase, weeks. Recovery phase, months to years. This is the repeating structure. First, a macro catalyst appears. Financial stress, geopolitical tension, systemic fear. Second, capital floods into precious metals. Prices spike, confidence builds, leverage quietly expands beneath the surface. Third, a secondary shock hits, sometimes unrelated. Funding stress rises, margin requirements change, liquidity tightens. Fourth, forced liquidation begins. It doesn't respect narratives. It doesn't respect headlines. It respects only margin math. Fifth, price disconnects from fundamentals. This is the painful phase. News appears bullish for metals, but price falls. Risk rises, but safe havens drop. That contradiction shakes conviction. Sixth, leverage exhausts itself. Weak hands are removed. Volatility compresses. Seventh, price realigns with underlying fundamentals, often aggressively. Right now, we are somewhere between stages 4 and 5. And here's why that matters. Markets in the short term are driven by positioning. Who is leveraged? Who is overexposed? Who is vulnerable to margin calls? In the long term, markets are driven by structural forces. Supply constraints, monetary policy, geopolitical shifts, industrial demand. Short-term positioning can temporarily overpower long-term fundamentals, but it cannot permanently erase them. If global instability is rising, if supply deficits remain unresolved, if central banks continue accumulating reserves, if industrial demand for silver continues expanding, then a falling price during a liquidity event does not automatically invalidate the thesis. It signals stress in the financial plumbing. The most misunderstood concept during crashes is this. Price is not always a reflection of value. Sometimes it is a reflection of forced behavior. When funds are liquidated, they sell at market. They do not negotiate. They do not scale out strategically. They exit. That creates air pockets, moments when bids disappear and price drops faster than logic would suggest. Those air pockets feel catastrophic in real time. Charts look broken. Sentiment collapses. Confidence evaporates. But when you overlay today's structure onto previous liquidation cycles, the similarities are uncomfortable. Sharp vertical drop, high volatility, simultaneous selling across asset classes, funding stress signals, narrative confusion. The emotional response is always the same. This time is different. Sometimes it is. But historically, forced deleveraging in precious metals during broader instability has been a reset, not a permanent destruction. That does not mean the bottom is in. It does not mean price cannot go lower before stabilizing. Forced selling can overshoot logical valuation. It often does. But overshooting is a feature of leverage unwinds, not evidence of permanent collapse. Right now, the market is flushing excess positioning, and flush phases are uncomfortable by design. They test conviction, they punish leverage, they reward patience. The investors who survive them are not always the smartest. They are the ones who understand mechanics. The key question isn't whether volatility exists. The key question is whether this is a structural breakdown, or another chapter in the historical pattern of liquidity-driven dislocation. And history suggests that when forced liquidation ends, metals don't whisper higher. They reprice. The only uncertainty is how long the flushing process lasts before equilibrium returns. That's the phase we are navigating now. Now here is the part that matters most. A falling price does not automatically mean a failing thesis. When markets enter forced liquidation mode, price stops reflecting long-term fundamentals and starts reflecting immediate liquidity needs. That is the distinction almost everyone misses during moments like this. Right now, what we are witnessing is not necessarily a collapse in the structural case for precious metals. It is a collapse in leveraged positioning. Those are two completely different things. If you hold physical gold or silver, the metal in your possession has not changed. Its weight is the same. Its purity is the same. Global supply constraints have not magically improved overnight. Industrial demand has not disappeared. Central bank accumulation trends have not reversed in a single afternoon. What changed is the paper price, the derivative price, driven by futures contracts and leveraged exposure. When leveraged traders are forced out of positions, they sell regardless of conviction. It does not matter whether they believe gold should be higher. It does not matter whether geopolitical tension is rising. When a margin call hits, cash must be delivered. If it is not delivered, positions are liquidated automatically. That air is what history shows with uncomfortable consistency. Forced liquidation events are temporary, even when they feel permanent. Every major deleveraging cycle in precious metals has followed the same progression. Price breaks key levels, sentiment collapses. Commentators declare the bull market over, retail confidence fractures. Then, once leverage is fully flushed from the system, stability returns. But the bottom does not form because fear disappears. The bottom forms because forced sellers run out of inventory. That is the moment when supply from liquidation dries up. Buyers no longer face constant pressure from margin calls. Volatility compresses. Price begins to move sideways instead of cascading downward. And once equilibrium is restored, price begins to reflect fundamentals again. The dangerous phase is the one we're in right now, the dislocation phase. This is when price and reality diverge sharply. Global risk can be rising while metals fall. Supply deficits can remain intact while silver drops aggressively. Monetary uncertainty can expand while gold retraces. It feels irrational because it is mechanical. Liquidity events distort pricing temporarily, but distortion does not last forever. Now, this does not mean the market cannot fall further before stabilizing. Forced liquidation often overshoots logical valuation. Lower highs can form. Additional downside probes can occur. Reflex rallies can give false hope before another leg lower. That is the nature of volatility during deleveraging. However, what ultimately determines the long-term direction is not the panic phase. It is the resolution phase. When funding markets calm, when margin calls decrease, when price holds a level for multiple sessions, when volume contracts on sell-offs, those are signals that liquidation pressure is fading. At that point, price no longer moves because traders are forced to sell. It moves because investors are choosing to buy. And that is when fundamentals reassert themselves. The most important thing to understand right now is this. Short-term price is being driven by positioning. Long-term price will be driven by structural reality. If structural conditions remain tight, unstable, and inflationary, then a liquidation-driven drop does not erase the macro thesis. It delays it. The crash phase tests conviction. The recovery phase rewards patience. The only question that remains is how long the flushing process continues before the market resets. Because once it resets, history suggests the repricing can be far more powerful than the decline that preceded it. Now I want to hear from you. Where do you think this move ends? Do you believe this is the final flush before stabilization, or do you see more downside ahead? Are you holding steady, adding cautiously, or waiting completely on the sidelines? Moments like this reveal different types of investors. Some react emotionally to red screens. Others step back and analyze structure, liquidity, and historical precedent. There's no shame in either position, but there is power in understanding what is actually driving price. If you are using leverage and felt the impact of this volatility, share your experience. If you're holding physical metal and ignoring the noise, explain your reasoning. If you believe this is the start of something much larger, I want to know why. Drop your analysis in the comments. Thoughtful perspectives help everyone think more clearly during chaotic markets. If this breakdown gave you a clarity, share it with someone who owns gold or silver and may be confused by the current price action. Many people see falling prices and assume fundamentals changed, when often it's mechanics behind the scenes. And if you want continued deep dives into market structure, liquidity signals, and macro shifts, stay connected. Volatility creates noise, but it also creates opportunity for those who stay informed. Stay rational, stay disciplined. What's happening right now is not an isolated event. It's part of a larger transition unfolding beneath the surface of global markets. Liquidity stress, geopolitical uncertainty, funding pressure, Commodity volatility, these are not random developments. They are interconnected signals. And when multiple signals flash at once, markets rarely stabilize quietly. The current gap between price behavior and global risk conditions is unusually wide. Historically, gaps like this do not remain open for long. They resolve, sometimes through continued downside exhaustion, sometimes through violent upside repricing. The only uncertainty is timing. If liquidation pressure continues, we may see additional lower highs, sharp bounces that fail, and further volatility before a true base forms. Markets often test patience before they reward it. But if stabilization begins sooner than expected, if funding pressure eases and selling volume dries up, the rebound phase could unfold quickly. Sharp recoveries often follow sharp dislocations. Either way, this is a pivotal period. These are the moments when leverage exits and stronger hands quietly position. When emotional decisions dominate headlines, but structural shifts develop quietly underneath. In the next breakdown, we'll examine the specific technical and liquidity signals that would confirm the flushing phase is complete, and what early strength might look like before it becomes obvious. For now, remember this: volatility is loud, structure is quiet, and structure is forming right now.